All right. Blackstone's REIT, which I kept seeing that acronym. I didn't know what it meant. BREIT. I thought that had something to do with Brexit, but
Yeah, that when I was searching it, it started to come up with Brexit stuff. But I would, if you see in the document, Ryan, you can click that Twitter thread. It can maybe help you out a bit, but I'll try to go through, summarize some of the points for the listeners. It's a long Twitter thread, and maybe we'll, if anyone's interested, check that out. But Blackstone is going through taking a ton of heat this week for limiting withdrawals um, on BREIT, which is BREIT. It's their fund. It's not publicly traded. At first, I thought it was an ETF, kind of like those other publicly traded REITs or whatever it would be, but it's not. Apparently, it's private. It has $69 billion in assets, and the REIT is focused on the private markets. Now, the big question is, why are they limiting withdrawals? Well, we have to understand how the fund works first because it's a weird fund that Blackstone kind of invented over the last, I don't know when it started, but I'm sure this concept's been around before, but just stay with me. So this is not just for BREIT, but for all the private REITs out there. So a private REIT is the same as a traditional REIT, but do not have public price discovery. So a REIT is a real estate investment trust. They invest in real estate. They have to pay out dividends. I believe it's a 90% rate, and that's what qualifies you as a REIT, as a real estate investment trust. But the private ones are different because they do not have public market price discovery. Now, what this means is that
so what the
they're
investors are just general partners and they're just getting paid out the cash in hand privately.
ish or limited partners, I think you mean, but ish,
Yeah, yeah,
sort of like that. You can envision it like that. But that what that means is that their NAV or the asset value of the fund is set by recurring appraisals, which quote unquote smooth the quote unquote volatility that would be there in public markets. So within this fund, performance has been great, and that's why they've accumulated $69 billion in assets. You know, we had low interest rates, rising rents, etc. They weren't in commercial real estate, which was smart. So people really loved them and they went into the stuff that was doing well, data centers, industrials, rents, I believe, is what they were saying. And that's why their NAV has been soaring. And fees for Blackstone have been great. I wouldn't even describe it as great. I would say absolutely fantastic. So they they have quite a bit of fees here. So they have a 1.25% management fee and then a 12.5% performance fee after a 5% hurdle, which isn't that bad. Each of those isn't that bad on their own, but I kind of combined it's a little bit, that's a lot for both to have both of those. And then they have a hefty selling fee, um, which we don't need to get into the details there. Is when you sell, there's also a flat fee that gets taken out. And that is equated to for
at any
fund
time,
owner.
or is that
Yeah, if
like
you
after a
take
lockup?
say if you take out your money, I believe it's at any time, but again, the thread and all the information I found didn't confirm that. So I think just say there's a selling fee, and from what I should say the thread person's name, Phil Bach, who's a great follow on Twitter, knows this space extremely well. He said from his calculations, again, just maybe it was back of the napkin math, but it's just roughly right that these combine to 3.6% annual fees each year, um, which is a lot. But again, some of that is because their performance has been good. And then on that $69 billion in assets, that is $2.46 billion in high margin annual fees for Blackstone. So the big question is you have an investment fund who invests in real estate, but real estate is highly liquid. What happens if investors want to sell? So BREIT investors, or excuse me, the fund, they could sell some of their liquid mortgage-backed securities, and then typically they just use inflows to offset redemptions. But right now, the real estate market is totally drying up because of rising rates. Inflows are drying up, and redemptions are heating up. So investors have tried to redeem at this high NAV because remember, they only appraise. I don't know if I mentioned it. They appraise the NAV or the asset value of the fund once a year. So right now, the NAV is stated at a much higher performance compared to all the publicly traded REITs. If you look at a chart that was shown in the thread, VNQ, which I believe is a Vanguard. Let me just confirm the name for everyone. Vanguard real estate ETF. So just say a really broad-based Vanguard type ETF. That performance used to track fairly
Share
closely.
your screen. Share your screen.
Oh, yeah. Okay. I'll show. Yeah. Smart.
Also,
Smart.
some
Smart.
comments in the chat. Bijan says, appreciate the content. You guys make a good podcast. Much appreciated. Then we've got a question from Tropical Storm, which we can take after this.
Okay,
but
yeah, I'm almost done, but it's important because I think it's going to be a great example of asset liabilities mismatches. So if you look at this chart here, might have to zoom in. The publicly traded one, VNQ, has totally fallen off a cliff this year. Not as sharply as during COVID, but again, pretty sharply. But the BREIT NAV is only going higher. So real estate investors or REIT investors have tried to get out of this because they're saying, okay, they're seeing the writing on the wall. It's pretty obvious. Interest rates are rising, real estate prices are falling. The NAV is going to decrease once they do their appraisals. So they try to redeem, but Blackstone has decided to gate redemptions, and investors now have to wait in line to sell their stakes. At the same time, and Ryan, you're gonna get mad when I say this. I know for a fact you're gonna get mad. Blackstone is still taking fees out on this artificially inflated NAV. So, first question.
that should be
And
illegal. That should be illegal.
well, see, I told you, I knew you were gonna get mad. Uh, Not talking about the morality. Maybe we can get to that later. Uh, can Blackstone sell properties at these appraised prices? Will this lead to a run on the bank? With a timing liquidity mismatch. We got a question from Matt H. How do you protect your peace with 500 tabs open? Yeah, that's how I go. Got a
I
lot.
think it's mentally insane, but
That's how my computer's big. It's only 20.
that's
Um,
insane. That's so I want to be able to focus. Especially
only
now they've got like the notifications that pop up on the tab.
only got one open at one time.
It's
Uh,
criminal. All right, to answer your question though, no, obviously I don't think who are they going to sell them to at appraised valuations? The only
yeah.
people they could sell them to is another subsidiary or fund that they start.
Yeah, Blackstone's their own fund.
Yeah.
So the question is what happens? It seems like they're just delaying the inevitable. Um,
After
I don't know.
they conclude their quarter, they will let the redemptions go,
Once,
and then they'll guide down.
yeah, they'll take the NAV down and then people can sell.
You
But
you let the quarter conclude, make the quarterly results look good, set expectations for next quarter, say it's the macro environment, and then guide down. And
what
then
what
you let the redemptions come out.
what do you think Blackstone is thinking here? Are they just betting that interest rates aren't going to rise more? Because I just don't see a way this doesn't end poorly and their investors getting either they lose a lot of Blackstone loses a lot of money. I guess it would be after earning a lot of fees, or B, their investors get pissed at them.
Mm, I would say B is a very likely scenario. I don't understand how they're still taking fees. That's the part that really pisses me off. And then,
Well, at the high price, yeah.
aren't there protections? There has to be protections for LPs in these scenarios where they can take it even if they have to have a high seller's fee. I wonder if they're completely holding withdrawals or redemptions, or they just have a ridiculously high early redemption fee.
I think that would have been talked about in the thread, so I doubt they have a ridiculous early redemption fee. But
But
I
how
think
can you?
it's the liquidity. It's the liquidity. I bet that was part of the contract that the investor signed. It's the liquidity where they could get a run on the bank if people try to redeem it. They wouldn't have the cash there. It would all be in real estate assets that you can't sell overnight.
But who cares if? Oh, oh, they just can't give them the money.
Yeah, exactly.